Hello everyone, and welcome to this deep dive into order blocks. If you've ever wondered how the big players, the banks and institutions really move the market, this is your key. We are going to move beyond simple support and resistance and look for the actual footprint of smart money. Part 1. What exactly is an order block? At its core, an order block is simply a specific candle or narrow price range where a large institutional order was placed, causing the price to aggressively shift direction. Think of it as a zone where the big money left a footprint that we can follow. We focus on two main types. Bullish order block. This is the last bearish sell candle before a strong sustained move up. It marks the point where institutional buyers stepped in and completely overwhelmed the sellers. When price returns, we anticipate renewed buying pressure. Bearish order block. Conversely, this is the last bullish buy candle before a strong sustained move down. It marks the point where institutional sellers began their distribution. When price returns, we anticipate renewed selling pressure. What causes order blocks? The market microstructure. To understand why these blocks work, we need to understand the challenge institutions face. A bank can't simply place a billion-dollar market order to buy your USD. Why? Because that single massive order would cause massive slippage, immediately pushing the price against them and giving them a terrible fill price. Instead of one giant trade, institutions split their large position into many smaller limit orders. They execute some immediately, and they leave the rest of their vast limit orders resting at a specific price zone. This zone, my friends, is our order block. Phase 1. Accumulation, distribution. The block. The institution executes its first block of orders, often triggering a move that sweeps liquidity or retail stop losses, GASP, to provide the necessary counter orders. This forms the order block candle itself. Phase 2. Displacement. The cause. Once enough orders are filled, the institution aggressively drives the price away. This sharp move, darling, is called displacement. It's so fast that it leaves behind a fair value gap, or price inefficiency. Phase 3. Mitigation the return. The institution knows they still have unfilled orders resting in that original order block zone. Therefore, the market will almost always be drawn back to that block to fill the remaining orders, or to mitigate the trade, before the true move continues. This return, my dear, is our high probability entry. The key takeaway. Order blocks work because they are areas of unfilled institutional orders that the market needs to revisit. Part 3. The 3-step strategy to trade order blocks. This is the most crucial part. You'll see that the code will never be able to lose it near an ongoing device. This will also come up in cases with improvement. Higher time frame context. Spot the order block on a daily or 4-hour chart. Higher time frames provide a more reliable institutional context. The last opposing candle precisely mark the high and low of the last candle going the opposite way before the aggressive push. Must show displacement and imbalance. The move away must be sharp, breaking key market structure, a change of character or break of structure, and leaving a clean, fair value gap adjacent to the block. No FVG, no trade. Must be unmitigated. Price cannot have returned to and traded through the zone already. Step 2 is simple. Be patient and wait for the retest. This is where most traders fail. They chase the price. You must wait for the price to return to the order block. Waiting for the price to enter the block allows for a tighter stop and a higher risk-reward ratio. A powerful tip is to watch the 50% mark of the order block zone. Institutions often look to re-enter at the most advantageous price, which is often the middle of the block. Step 3 is execution with confirmation and discipline. We now have our zone, but we never enter blindly. We need the final confirmation that the big money is back. For confirmation, drop to a lower time frame, like the 5-minute, and wait for a small-scale change of character or an engulfing candle to appear in the direction of the original impulse. For risk management, place your stop-loss SL logically just beyond the edge of the order block candle. Set your take-profit TP at the next highest or lowest liquidity pool, a previous swing high or low. Most importantly, aim for a minimum 1 to 2 risk-reward ratio, and risk only 1 to 2% of your account per trade. And now let's spot some real-time order blocks so you'll get a better understanding of these blocks. And here in Euro USD, we have found an order block right here. So what we do, we draw a zone and wait for the price to test this zone. And remember always the before impulsive candle, but if the candle is too small, you can just draw the zone to the impulsive candle. And since we drawn the box, let's go to lower time frame to trade it perfectly. And you can see the price came to this zone with impulsive move, and here before rejecting price gave us a pattern. A piercing pattern, which is a confirmation to take an entry. So we take entry here with stop loss above the or at the zone high, and target as swing low. Now let's look at another few examples. And now let's spot some real-time order blocks so you'll get a better understanding of these blocks. And here in Euro USD, we have found an order block right here. So what we do, we draw a zone and wait for the price to test this zone. And remember always the before impulsive candle, but if the candle is too small, you can just draw the zone to the impulsive candle. And since we drawn the box, let's go to lower time frame to trade it perfectly. And you can see the price came to this zone with impulsive move, and here before rejecting price gave us a pattern. A piercing pattern, which is a confirmation to take an entry. So we take entry here with stop loss above the or at the zone high, and target as swing low. Now let's look at another few examples. And here in Euro New Zealand dollar, we found an order block, so we draw the zone for the cause of the move candle. Then, we now go to a lower time frame. And remember, the lower time frame choice is yours, but it should be between 3 minutes to 45 minutes. And as you guys can see here, the price is getting rejected with strong candles, so we take entry at this candle and the stop loss at the zone high and target at the previous swing point. Let me give you some homework. Go to old data, find a zone, and paper trade them using the replay option in TradingView or other websites that can provide backtesting. And then, make notes or a folder and screenshot every block and the entry you found. After getting like 40 to 50 screenshots, analyze all of them and find a pattern that works for you and you can trust it. With this method, you'll be able to wait patiently for entry, knowing it will go as you thought, giving you proper discipline. Now, let's find one last block. And finally, we found our last order block in US Swiss franc. And you see here the cause candle is too small, so what we do, we draw the block for the impulsive candle. Now let's go to lower time frame. And if you look, the price actually getting rejected here. The price did reach to this block, it having deep divide into it, leaving us at confusion. At these times, it's best to leave it. But if you really want to take entry here, then look for a strong impulsive, or look for momentum. Here we found both, so we take entry here and stop loss. Since the zone is too big, we can keep the stop loss at the 50% of zone, and our target at these swing points. Remember, these are risky types of trades because the price haven't fully mitigated into the block, so always use stop losses at these types of setups. And always don't take entry based on one factor. And that's all we have for this video. And don't forget to do the homework. If you did your homework, comment down below saying number trading core homework. As always, see you in the next video.